Well, good afternoon. First of all, thank you very much to Vladimir, and thank you very much to Santiago for allowing me to be part of these sessions. Thank you very much to each and every one of you here who are interested in this enormous work being done by the central bank, together with that colossus we have as Minister of Economy, Toto Caputo, whom textbooks will remember as the best Minister of Economy in Argentine history. The presentation I'm going to give consists of 3 parts. In the first part, I'll describe the legacy we received. In the second part, I'll discuss the diagnosis and the key, fundamental role that sound economic theory plays in precisely solving these types of problems. And in the last part of the presentation, I'll discuss the policies implemented and the results we're achieving, and what we expect going forward. In that sense, regarding the legacy, one of the things that was truly shocking was what was happening with the inflation rate at the beginning of December. When we looked at inflation for the first week, daily inflation was 1%. If you annualized that, it meant inflation was traveling at 3,700%. These numbers I'm going to give you seem exaggerated, but when I explained the monetary imbalances that would have led to validating these, let's say there would have been monetary validation that would have allowed this to spiral and continue. When you looked at the first 2 weeks of December, the rate was already at 1.2% daily. In other words, it had accelerated. And that, in annualized terms, was 7,700. On the other hand, you have concrete data on December's inflation in retail prices, that is, consumer prices, which was 25.5%. And that, in annualized terms, is close to, I don't have the microphones calibrated properly, because I'm constantly hitting them, so I either choose the glasses or the microphones. So if you hear strange things, it's because I bumped into the microphones. It was an inflation rate that was traveling at 1,500%. But if you take it in wholesale terms, that 54% annualized rate gives $17,000%. In other words, we were on the verge of a macroeconomic collapse. Furthermore, it wasn't just what we were seeing, let's say, as a symptom of this problem of the accelerating inflation rate, but there were also the initial imbalances, which could have led to the monetary validation that would validate inflation precisely. We basically combined the imbalances of the 3 worst major crises in Argentine history. On the one hand, we had a monetary surplus, the famous Manny overhang, which was double what we had before the Rodrigazo. In fact, we're publishing an article in The Economist, and the people at The Economist asked us for this estimate. Luckily, Federico's team, from that colossus I also have as Minister of Deregulation, Dr. Federico Sturzenegger, took advantage of the luxury of re-estimating the money overhang, and it was precisely double what we had in 1975, that is, before the Rodrigazo. Why is this important? Because inflation before the Rodrigazo was 30%, and when the Rodrigazo hit, it jumped to 180%, that is, the inflation rate multiplied by 6. If we were experiencing inflation of around 200%, clearly multiplying it by 6 would have meant jumping to levels of 1,200%. But if the imbalance was double, it meant at least jumping to 2,400%. On the other hand, we had an additional problem, which was the central bank's situation in terms of interest-bearing liabilities. The ratio of interest-bearing liabilities to the monetary base was around 4 times that. In other words, this situation is even worse than what we had before the hyperinflation of '89, with monetary base levels in terms of GDP similar to those at that time. Therefore, the fall in money demand would have strongly, and very easily, led to hyperinflation levels. At the peak of hyperinflation, the monetary base in terms of GDP fell to 0.2%. And during the hyperinflation of '89, we had inflation of 5,000%. This was further aggravated by the fact that we had a set of interest-bearing liabilities maturing in 30, 60, 90, and so on, up to 270 days. And the previous government intentionally, this was no coincidence, shifted all those positions to one day. Therefore, we had that bomb ready to explode in one day. That is, we could quintuple the amount of money in one day. Basically, the previous governments bet they didn't really believe we were libertarian liberals. They actually considered us to be retarded liberals. In fact, in the public debate, you'll find plenty of libertarians who, in the name of freedom, will say that if we had done that, we would have precipitated hyperinflation. Peronism would have taken its entire force to the streets. They would have looted our supermarkets. This dynamic we already saw during 2001 or 2002 with the coup d'état carried out by Alfonsin and Duhad against de la Rua. A coup that ended, and the looting ended, let's say, when Duhad came to power. That was what they had planned. Therefore, not only would we have generated hyperinflation, we would have taken the situation to the extreme. If you look at the increases in poverty in 2001, 2002, and in '89 and '90, the increase in poverty would have meant reaching levels of at least 90% poverty and 50% destitute, a true calamity. And not only that damage, but the populists would have also completely killed any glimmer of a liberal solution. Because what worries the political party, which, in reality, includes everyone, the entire political caste, which is, I mean, the party of the state, most is being in power. But if they also make someone else pay the cost, it's a party of their own. And that's what they were looking for, to have everything blow up very quickly and return to power by January, when the entire imbalance was cleared, to blame all this on us, seize the cyclical recovery, and enter a cycle of endless populism. And there was also the aggravating factor that we had social indicators that were worse than those we had in 2001. At the same time, we had an imbalance in flows. The fiscal deficit, adding the national government, that is, the Treasury and the central bank, reached 15 points of GDP. 5 were in the Treasury and 10 were generated by the central bank, which is the quasi-fiscal deficit. And, at times, the exchange rate gap was around 200%. That's why I find it funny when some analysts say, Milei devalued. If the gap was 200% and net international reserves were negative by almost $12 billion, I didn't devalue. In other words, the devaluation was already there. It was simply a matter of being honest. But we didn't just have the problem of these flow imbalances. We also had stock imbalances. As I mentioned, we had negative international reserves of around $12 billion. We had debts with the central bank, including the SIRA and TRAP dividends, of around $50 billion. We had debt in pesos maturing soon for the equivalent of $90 billion. We had $25 billion in foreign currency debt maturing. Much of that debt was with the International Monetary Fund, but the program had fallen through. And this is also interesting because, generally, when one has a situation of recurring defaults. Rebuilding that situation with the fund can take between 3 and 6 months. And the reality is that the economic program was so solid that, in one weekend, the International Monetary Fund gave us the opportunity to move forward. Obviously, it did so with reservations that many had about, for example, the impossibility of achieving a zero deficit. We aimed to achieve a zero deficit by 2024, that is, by the end of 2024. I remember many domestic economists saying it was impossible to adjust more than 1 percentage point of GDP, that it was crazy, and all the epithets associated with that about me and, above all, about me carrying a chainsaw. But we showed the fund, we proved the consistency of our program, and the truth is that the goals were much more ambitious than those proposed by the International Monetary Fund, so it was implemented very quickly. And the reality is that what seemed impossible to achieve over the course of a year, we achieved it in a month. That is to say, Argentina, which ran a deficit for 113 of the last 123 years and defaulted for the 10 years it didn't, achieved a zero deficit in the first month of my administration, an achievement we have not abandoned to this day and will not abandon this year. And the budget law we submitted is based on a zero deficit for the first time in Argentine history. And we will strictly adhere to it and resist whatever we have to resist. Because when it came to putting what needed to be put on the table, risking fiscal balance in the face of sensitive issues, and when the populists wanted to upset the balance of public finances, we did what we had to do regardless of the impact it might have on my image. Because I didn't come here to, so to speak, protect my image and pursue a political life. I came to fix Argentina's problems, and I'm willing to pay whatever costs I have to pay. And if I have to veto retirees, and if I have to veto, let's say, the frauds who defend their jobs through universities with outright lies, I'll do it, because my commitment to fiscal balance is unwavering, and that's what I did. Naturally, among all the stock problems we had, there was also the problem of the puts. You'll remember what that part of the discussion was. So, that was what we were faced with, and we were facing a catastrophe. We needed to react strongly and quickly. Fortunately, we had been working on an economic program to maintain a very strong relationship of consistency and, well, we're taming this wild bull. So, now the second part of this presentation has to do with the diagnosis, and here, what one believes in terms of economic theory and the consequences in terms of economic policy play a very important role. I know that some parts are very basic for many of the eminent figures sitting here, and I apologize for having to listen to simple things about some of them, but there is also a broader audience and there are students, and I think it's worth refreshing or keeping some concepts in mind. And some things should also be good for us to keep in mind, even as professionals and very prestigious, because it is the basis on which we think about this problem. We are convinced of the monetary nature of inflation. That is, inflation, for us, is always and everywhere a monetary phenomenon generated by an excess supply of money, either because supply increases or demand falls, or because both occur simultaneously, and that generates a loss of the purchasing power of money. Since all prices are expressed in monetary units, they rise. That is our diagnosis. Now, that, in addition, given this whole discussion, because just as we are proposing this, there are other professionals who consider inflation to be multicausal and all that kind of thing. The truth is that these are hypotheses I don't subscribe to, but that's part of another discussion. I'm here to tell you how we see it, what we're doing, and then those who truly understand will end up writing the history properly. So the question is, well, where does this hypothesis come from? That is, how do we look at this problem? So, from my point of view, the first thing we have to do is, because in fact, defining inflation as a generalized rise in prices is not the same as defining it as the loss of the purchasing power of money. Because if the problem is a generalized rise in prices, then we get the same old cavemen, who have been failing for over 4,000 years, trying to control prices. Aside from the fact that this has an associated problem of value theory, of believing that prices are a markup over costs, that is, a problem of objective value theory. A theory that was defeated, I say, in 1871 with the appearance of Menger, let's say when he wrote his Principles of Economics and Politics, and which he did in parallel with William Stanley Jevons and Leon Walras. I wanted to mention Walras. Can you imagine why? Aside from that, one should think, what would the world be like without money? Well, we study the world without money. It's usually studied in the last part of microeconomics course models, in the general equilibrium section, which are barter models. Now, the problem is that, in a barter economy, you encounter two major, but not minor, issues. One is the problem of double coincidence, that is, you encounter someone who wants what you have to sell, at the same time that that person has what you want. That's a significant problem. But even if you find that counterparty, there's also a problem of indivisibility. That is, I like bread, I eat bread, and I meet a baker, but I'm probably not willing to give him a lecture for a kilo of bread. And the number of kilos of bread that a lecture of mine would entail, at least now. And I hope to do things right so I can make a living from this when my political career ends. Given that I've given up my privileged retirement, the first in history, we are convinced of the monetary nature of inflation. That is, inflation, for us, is always and everywhere a monetary phenomenon generated by an excess supply of money, either because supply increases or demand falls, or because both occur simultaneously, and that generates a loss of the purchasing power of money. Since all prices are expressed in monetary units, they rise. That is our diagnosis. Now, that, in addition, given this whole discussion, because, just as we're proposing this, there are other professionals who consider inflation to be multi-causal and all that sort of thing. The truth is, these are hypotheses I don't subscribe to, but that's part of another discussion. I'm here to tell you how we see it, what we're doing, and then those who truly understand will end up writing history accordingly. So the question is, well, where does this hypothesis come from? I mean, how do we look at this problem? So, from my point of view, the first thing we have to do is, because in fact, defining inflation as a generalized rise in prices is not the same as defining it as the loss of the purchasing power of money, because if the problem is a generalized rise in prices, then we get the same old cavemen, who have been failing for over 4,000 years, trying to control prices. Aside from that, there's an associated problem with value theory, with believing that prices are a markup over costs, that is, a problem with the objective theory of value. A theory that was defeated, I say, in 1871 with the appearance of Menger, let's say when he wrote his Principles of Economics and Politics, and which he did in parallel with William Stanley Jevons and Leon Walras. I wanted to mention Walras. Can you imagine why? Aside from that, one should think, what would the world be like without money? Well, we study the world without money. It's usually studied in the last part of microeconomics course models, in the general equilibrium section, which are barter models. Now, the problem is that, in a barter economy, you encounter two major, but not minor, issues. One is the problem of double coincidence, that is, you encounter someone who wants what you have to sell, at the same time that that person has what you want. That's a significant problem. But even if you find that counterparty, there's also a problem of indivisibility. I mean, I like bread, I eat bread, and I meet a baker, but I'm probably not willing to give him a lecture for a kilo of bread. And the number of kilos of bread that a lecture of mine would entail, at least now. And I hope to do things right so I can make a living from this when I finish my political career, given that I've given up my privileged retirement, the first in history. The truth is, I don't need that much bread. So, I say all this because, if one were to truly take it seriously, this would lead to an enormous amount of transaction losses, and therefore, we would have a truly abrupt and violent drop in well-being. So, look, you won't believe where I'm getting this reference from, but this reference is from Joan Robinson. She said that, when the issues of the neutrality of money were analyzed, they weren't well thought out, because the barter economy is not the same as the monetary economy, and that's a significant issue. Now, faced with that situation, one has to understand how money appears. And, in reality, it's not that individuals started crying because they couldn't make transactions and were struggling through life. They tried to find a solution, and one of the things they discovered was that there were some goods that were exchanged more than others. So, one of the things they discovered was that if they went and bought that good that was exchanged more, it indirectly helped them buy what they ultimately wanted. In other words, money is actually an indirect exchange good used to make transactions. For example, when humans were nomadic, the most important thing, for much of human history, was food. So, things related to food were important. Nomadic humans bartered and had money, if you will, as an indirect exchange good, and it was precisely livestock. They used livestock as an indirect exchange good. Now, later, humans became sedentary, and one of the things they ate a lot of was bread, and bread is made from wheat. So they started transacting in wheat, not because they wanted to own wheat, not because they wanted to accumulate wheat, not because they wanted to have a lot of wheat, but rather because they really wanted to use it as an indirect exchange good. In that sense, you have different currencies like wheat, like flax, like coffee, like tobacco. I always find a Milton Friedman lecture on hyperinflation in Germany very amusing. He says, cloves were used, and at one point, cognac was used. And he says, it was the most liquid definition of money I've ever encountered. So, if you look at all these goods, they fulfilled two of the roles that money should fulfill, being a unit of account and a general means of payment. But the problem with these goods is that they're like ice cream, right? Not as violent, but they're like ice cream. It doesn't have a negative interest rate. In other words, if you don't eat the ice cream now, it melts, leaving you with nothing. These goods also, whether due to the passage of time, whatever, let's say, were losing value. And consequently, they were no longer useful as a store of value. And from this problem, metallic currencies appeared, whether gold, silver, and copper. But more, and there you have the three functions of money. No, I'm not going to go into the whole discussion about when paper money appeared and all that stuff because I'm going to get dense. But what I'm interested in noting in this, the most important thing from my point of view, is that the demand for money is a derived demand. That is, no one demands money for no reason. No one is planning to take a peso, a dollar, or whatever currency they fancy, to the wooden suit. No one is thinking about that. Furthermore, in fact, inheritance is a miscalculation. So, put another way, the demand for money is a derived demand. It's a mirror demand of what's happening on the real side. Now, notice that, if I put it in these terms, the demand for money at each moment in time is a function of consumption. That is, there's no need to factor in income in the interest rate, which is an aberration, and I'll explain it now. Because if I factor in the entire consumption path, that will give me the demand for money at each time period, and I'm working in a general equilibrium model. Right now, I'm working under normal pressure and temperature conditions, so I can see, let's say, how do they kill an elephant? Little by little. In that sense, if you look at a general equilibrium model, what do the excess demand functions ultimately depend on? On what Robert Lucas Jr., may he rest in peace, called deep parameters. That is, it depended on preferences, technology, and endowments. If you want, you can add, as an additional element, honoring the Nobel Prize winners who were recently announced, the property system to include institutions. That said, that vector is constant. And if that vector is constant, the consequence is that the consumption path is granite-like. In other words, you can solve it by applying Pontryagin's maximum principle, if you want to solve it. And you can do it discretely or continuously, applying it however you want. Or you solve it with Bellman, or whatever occurs to you. Or you do it with the Lagrange method, I don't know, whatever you want. But that path is a rock. And, therefore, the demand for money is granite-like, because it's a mirror of that. That is, you need it precisely to be able to carry out transactions. Therefore, under normal conditions, the demand for money should be somewhat granite-like. Note that, then, the classical philosophers weren't so foolish when they developed the first, rudimentary versions of the quantitative theory, where they argued that the demand for money is a constant proportion of income. They weren't that crazy. In fact, the problem is that this money demand function is inconsistent with a general equilibrium model, because prices in the general equilibrium model are homogeneous to degree 0, and this would be homogeneous to degree 1. This raises some inconsistencies in the functioning of the system, but they weren't that crazy or that foolish. So, under normal conditions of pressure and temperature, just as the consumption rate is fixed, the consumption path should also be fixed. Then the demand for money, the real demand for money, and that must equal real balances, is the nominal quantity divided by the price level. Therefore, you see that the price level is determined by the ratio of the money supply to the real demand for money. And the only thing the central bank can do when it includes money is to determine the nominal scale of the economy. And there's also the question of the nominal anchor. That is, the quantity of money is what ultimately generates the idea of the nominal anchor, which is to determine the price level. And obviously, if the demand for money is given, if I increase the supply of money, the consequence is that the purchasing power of the currency must fall. That is, prices rise. In other words, this situation where inflation is always and everywhere a monetary phenomenon, generated by an excess supply of money, either because supply increases or because demand falls. In this case, the underlying parameters didn't change. They shouldn't have to change, and consequently, this leads to a loss of the purchasing power of money, and all monetary units rise. That's basically the central thesis and where it comes from. Naturally, if one thinks in these terms, because I say, to think about this, let's say we're not going to be holding seminars or anything like that. Especially because we can do all the nice calculations, and then there are the orcs. The orcs come and talk to you about squaring the circle, the virgin whore, and all that stuff. So the consequence is, well, what do we think about in terms of monetary policy? You have two ways of posing the problem. One, with exogenous money, and the other, with endogenous money. One way of thinking about this problem with exogenous money involves fixing the quantity of money. Therefore, when you fix the quantity of money, what you're automatically fixing, in a sense, is the price level. That is, it adjusts to the conditions of the general equilibrium system on the real side, and the price level is determined. Obviously, I'm working with functions that are homogeneous of degree 0, not degree 1. That is, it's not strictly like the old quantity theory. In that sense, what's going on? If I fix the quantity of money, the natural consequence is that, if this vector of preferences, endowments, technology, and property allow technological progress, let's suppose that technological progress could be described, again, exogenously. Real life is more complicated. The consequence would be that you would have an economy that expands, that grows, and, therefore, that economy would generate deflation. That is, it would be an economy where, if the quantity of money is constant and you have more and more transactions and more demand for money, the flip side of that, if M is fixed, you should have deflation. I warn you that the problem of deflation is a problem of modern literature. If you look at literature prior to the 20th century, that is, in the 19th century and further back as well, this wasn't something that was discussed. There's a wonderful book on the subject by Philip Boggess called Defending Deflation, and it wasn't a problem. It's a modern problem because we're used to living with inflation. Furthermore, anyone who claims it's a problem is insulting the private sector. It's not my fault that a policymaker is so stupid that he doesn't understand that I can make contracts in real terms and neutralize them in terms of inflation. In fact, one of the things we did with the zero deficit was to precisely move fiscal policy according to income and, therefore, according to inflation and what happens to the level of activity. The other option is a monetary rule. Establish a way in which the money supply grows so that there is no deflation, because, basically, in the previous case, there will be deflation, given that the money supply doesn't grow and the economy grows. Deflation will be in line with that economic growth. The other option is to set a growth rate for the money supply and, unlike what happens with the growth rate, that will end up determining the inflation rate. This, again, is in pressure and temperature mode. When we start putting things into it, it starts to move quite a bit more. But the interesting thing is that there you would have a different pattern of movement. The reality is, who sets that rate and why? Again, we encounter the issue of fatal arrogance. The first question is, why is deflation bad if deflation is a way of returning income to the rest of the population? Yes, obviously, against the state. That's all very well. Not only that, but also if I'm going to set it, why would I set it? Based on what? Why would I set it? Because the reality is that if I set the amount of money, then you say no. But I have some guys who are so brilliant that they'll set the amount of money according to what people want. And if people can do it, why do I need a third party? Let people choose their own money and determine the amount of money based on what they want, and that's it. So, if the central bank expands, it causes harm. If it contracts, it causes harm. And if it leaves the amount constant, it also causes harm. It always causes harm. The issue is how much damage it causes. The way it causes the least damage is if it doesn't move the money supply, but that's part of another discussion. That's one monetary policy framework. The other monetary policy framework is the endogenous money model. Without a doubt, the best known, the most popular, is the one in which the exchange rate is fixed. In what would be the terminology of Julio Hipólito Guillermo Oliveira, in his work on passive money, I think the translation is about passive money. He talks about what's called the external standard, which is when you fix the exchange rate. Now, when you look at an open economy, back in a very simplified model, you have purchasing power parity, where local prices are equal to the exchange rate times international prices. Now, if I'm setting the exchange rate and I'm a small economy, that means local prices are determined for me. So, if I have fixed prices, and if my ratio of the real quantity of money, that is, M over P, is equal to L, which is fixed, and now I have P abroad, then what is endogenously determined is M. That is, the quantity of money within the economy is determined endogenously, based on what's happening in terms of inflation abroad or what's happening with the demand for money. That is, if the demand for money increases for me, for example, I'll end up expanding the quantity of money. This is not insignificant, because I could say that the monetary base is equal to reserves plus domestic credit. And when I set the exchange rate, then if I increase domestic credit, I lose reserves. I mean, this seems like a rather silly thing, but Kirchnerism didn't learn it. As a consequence, later, when they start losing reserves, they start imposing capital controls. But the important thing is to see that money is now endogenously determined, because given P, which is given by the PPP, and given L, which is given by the mirror demand associated with the intertemporal consumption path, that's where I get the quantity of money so that I can map this out. Naturally, there are other mechanisms for thinking about this problem. This is one of many. One is the commodity standard. Note that the commodity standard, in some sense, bears a certain resemblance to this, but the commodity standard has a subversion, or an equally linked version, which is what's called the wage standard. I mention this case because there's a lot of talk about distributive bidding models. So, you now determine the price level as a markup on labor costs, netted by productivity. In this way, they determine prices, and the quantity of money should adjust to that. So, when the distributive struggle appears, the problem lies in that this distributive struggle suddenly manifests itself in a higher price level. And this higher price level requires monetary validation so as not to pay for it in terms of activity. Basically, the problem with that model, which, suddenly, others don't necessarily have to have, is the fact that it has a value theory problem. Because, again, I'm saying that prices are a markup on costs. Or I can say it's the cost of labor to establish the distributive struggle. The problem with that is that I'm now working with an objective theory of value, and we already know that the objective theory of value was annihilated. Therefore, everything that has to do with acts of brutality, like what the Soviet monstrosity did, where people controlled prices, then I believe that, by adding up the costs from there, let's say, they arrived at the price level. So they were trying to determine who the bad guys were. Remember the former president saying, "There are devils." Well, the forces of heaven killed them. And then, thank you, Dario. The other endogenous money model is what Oliveira called the credit standard, which was the act of fixing the interest rate. Basically, there's a problem there, because now you're not determining the quantity of money or the price level. In other words, you have the problem of what's called the nominal anchor. That is, since the M is not fixed, you can't determine the P. Consequently, the system is left adrift, and that's why inflation expectations are so important. Why? Because that allows you to link future prices with current prices, allows you to determine P, and from there, determine M, and from there, solve the model. The truth is, this whole controlling the interest rate seems like an aberration to me. Remember, everyone knows of my admiration, affection, fondness, and all the definitions you may have, but since we're friends, I can tell the anecdote with Federico Sturzenegger when he decided to switch to inflation targeting. I asked him what he thought of Moreno, and he said, "Caveman." Yes, if you want to boo him, boo calmly, there's no problem. I mean, he's always campaigning for me to be removed. So, if you want to say whatever you want, I'm not going to deny it. That said, obviously, we all have a pretty low opinion of Moreno, especially because he has a poor theory of value. He believes prices are determined by costs. This is very important. One of the things Menger proposed in his Principles of Political Economy of 1871, and later rewritten by von Wieser, is what's called the imputation principle, where prices determine costs, not costs that determine prices. It's so ridiculous to believe that costs determine prices that, if this were the case, there would be no bankruptcies. It wouldn't make sense to be efficient either, since I'm going to be able to shift costs. It's something that really makes no sense at all. But if you want, watch the whole discussion about the labor theory of value and the subjective theory of value, so I don't bother you with this kind of thing. And why is controlling the interest rate aberrant? Because controlling the interest rate is equivalent to the controls Moreno implemented, but also intertemporally. Because, ultimately, what is the interest rate? The interest rate doesn't exist because money exists. This is an exoset of Mr. John Maynard Keynes in the general theory. Strictly speaking, the interest rate doesn't exist because money exists. The interest rate exists because time exists. The interest rate has to do with the rate of intertemporal preference. I mean, it's also a profound parameter within preferences. Therefore, the interest rate is actually the relative price of future goods relative to present goods. Or why do you think that when the interest rate rises, savings rise? Because what is savings? Savings are future consumption. So if I'm raising the interest rate, the present price is rising. If the present price rises, I substitute present consumption for future consumption. That's why you see that when the interest rate rises, savings rise, but in reality, I mean, go. Intermediate Microeconomics, the intertemporal chapter, and it shows you precisely this problem of relative prices, the interest rate. I mean, you don't have to be very sophisticated either, or solve the dynamic optimization problem. And when you look at the utility ratio and the interest rate, obviously the rate of time preference appears. You'll find that those same conditions are the same as if you had set prices. That said, then, it's an aberration to want to control the interest rate because it implies being so arrogant as to want to control not only current prices, but also future ones. In other words, it's like being Moreno reloaded. He's the Incredible Hulk version of Moreno. Therefore, I'm not in favor of controlling the interest rate. I say, since we have a central bank, for now, we'll control the quantity of money. It doesn't matter because, since Santiago and Vladimir are brilliant guys, they'll get jobs elsewhere, but they will have done an enormous service to the country the day we leave this job and end this filthy mess called the central bank. It's like the frog and the scorpion. Don't ask it to change. So, given this theoretical discussion, we had to address the problem of stopping hyperinflation. So, we had three factors for expanding the base. One is what's called the public sector, which is financing the fiscal deficit. Another is the financial sector, and the third is the external sector. When we decided to achieve a zero deficit, it was basically a way to cut off the issuance of money to finance the treasury. If you use the Cerro-Maloney methodology, from 1901 to the present, Argentina has had 23 crises. Of those 23 crises, 21 have a fiscal origin, where the fiscal deficit can be large or extravagantly large. The extravagantly large cases are, for example, the Rodrigazo, with 14 points of GDP in 1975, the exchange rate crisis in 1982, with 11 points of GDP, Alfonsin's hyperinflation, with 8% in 1989, convertibility in 2001, with 7. Well, in the consolidated system, we had 15. To give you an order of magnitude, in that sense, it was essential to reduce the fiscal deficit and, hence, achieve a zero deficit to end fiscal-type issuance. Now, regarding the quasi-fiscal deficit, we had two sources, and we achieved that in the first month, turning off the fiscal spigot. We had to put an end to the remunerated liabilities, because the problem of remunerated liabilities was a significant issue, because what they generated was larger and larger quasi-fiscal deficits, increasing the amount of future money, because, basically, all those remunerated liabilities were future issuance, therefore, they represented future inflation. So, basically, we had to stop the spiraling and growth of those remunerated liabilities, which were generating a fiscal deficit of 10 points of GDP, and making the economy truly shaky. And it's important to have this discussion here, because many economists suggested that this could be stopped by raising interest rates. And if we had raised the interest rate, today we wouldn't be talking about stabilizing, but rather, we would have been talking about the carry trade. We would have been talking about the relationship. Today, interest-bearing liabilities would probably be 10 to 1 with the monetary base. We would be discussing when hyperinflation occurs or when that bond position would be expropriated. Therefore, if anyone is in favor of the interest rate, I want to tell you that we dealt them a defeat. We did it by not using the interest rate as a mechanism. Because if we had used the interest rate, if we had done what the International Monetary Fund and many local economists said, we would have been in hyperinflation today. What we did was something else. Basically, in the face of the exchange rate imbalance, we made a correction, bringing the exchange rate closer to the market rate. Why is this so important? Because what lowered the excess supply of money? How is money overhang generated? Money overhang is generated because you have a fixed exchange rate, you're issuing money, you start losing reserves, you implement controls, and what that does is artificially increase the demand for money to charge you an inflationary tax. Not only is it violent and is the lie of inflation, which is an unlegislated tax, but you're also forcing them to demand more pesos by force to charge more inflationary tax. Totally immoral. But, aside from that, what's most interesting about this situation? If we had done what they said, we would first be in an inflationary frenzy, but not only that. By keeping the exchange rate close to the market rate, when they corrected for the country tax, what we did was reduce the excess demand in the foreign exchange market, and therefore, we reduced the excess demand in the foreign exchange market. Therefore, we reduced the excess supply in the rest of the economy. Reducing excess supply in the bond market meant that the interest rate fell, and therefore, country risk fell. Reducing excess supply in the goods market meant that the decline in activity was not as great, and therefore, employment did not fall as much, and therefore unemployment did not explode. That's why we made the largest fiscal adjustments in human history, if I take the national government and the central bank into account, and yet there were no social problems. I mean, there is a part of the program that has to do with social policy implemented through human capital, but it would take an extra hour, and I don't want to bore you with my presentation. So, in that sense, you'll see how interesting it is. Because the other day José Luis Daza explained, the characteristic of this program is that while all other experiments with similar characteristics involved GDP declines of around 10%, if you look today at the July data from the seasonally adjusted EMAE, Economic and Monetary Policy, compared to December, the decline is 0.6%. If you look at industrial production, it's at the same levels as November. If you look at what we did, for example, in 2002, GDP fell 11%, 10.9%, but in the second quarter, when the adjustment took place, it fell 16%. I'm not a giant, my Minister of Economy. But with the social consequences that this entails, I mean, having thought about the problem of where we set the exchange rate, because we couldn't open under the liberalized logic, meant precisely finding a market proxy that would minimize that excess demand. At the same time, one of the things that was happening is that I remember that when we achieved a surplus in January, they told us it was a coincidence. The second time it was a coincidence. Well, there came a time when they realized the fiscal commitment was real. Consider that, from having 18 ministries, we reduced it to 8. We made a lot of cuts in public employees. We eliminated public works altogether. We eliminated discretionary transfers to provinces altogether. And obviously, there were also items that had an adjustment mechanism that were diluted, but were later restructured, and yet the fiscal numbers are here. So that allowed us to show that the zero deficit policy was working and that it was working seriously. And zero deficit implies that I'm not taking on new debt. That is, I can be rolling over the debt, but I'm not taking on new debt. In fact, I tell you that in the last 40 years, a single government reduced the debt through market-based means, not compulsorily, not with haircuts in renegotiations. We paid $20 billion. And as this was happening, what does it mean? It means that your debt-to-product ratio isn't increasing. Therefore, it means you're solvent intertemporally. Consequently, that also explains the drop in country risk. Today, country risk ended at 1047, the lowest level in the last 5 years. Furthermore, when we were discussing the university issue, because more than anything because of what it implies in terms of signaling the fiscal deficit, one of the things we did with Federico was ask his team to estimate the impact of country risk on GDP in dollars. If we, let's say, with this level of country risk, say we have a GDP of 600 trillion, no, $600 billion. If we go back to the old ways and with a country risk of 3,000, let's say, GDP goes to $400 billion, which would mean a loss of a third of GDP, or we gain, let's say, 50% more GDP compared to the case of 3,000 basis points. In other words, it's not a minor issue in terms of GDP per capita. It's not a minor issue in terms of the discussion about universities, where at no point was the public university in question, nor was the non-tuition system in question, because nothing is free. There's no such thing as a free lunch. But what happens if we went back to our old ways and reached a country risk of 3,000? Because we began to give in. I recommend the book, Historias del Quinto Piso, as if, let's say, the Alfonsin government began to give in to pressure and ended up in hyperinflation. So, in that context, we didn't negotiate. What's more, if you go to the equilibrium where the country risk goes to 3,000, the amount of dollars going to the university is the same, but the difference is that I have a lower per capita GDP, a third lower. And since that drop in GDP is 1/3 related to economic activity, but 2/3 is due to a jump in the real exchange rate, that means that the number of poor and indigent people also increases. And we won't tolerate a break in our arm regarding fiscal balance, nor will we tolerate such damage to the Argentine people, I mean, by a group of criminals who don't want to be audited. Fortunately, the ruling came out today, and we'll be able to audit them. The thieves are in danger. And as we were moving forward with fiscal balance, that's where this giant here, Dr. Pablo Corneau, came in and began to put the debt back where it always belonged. That debt was the national government's debt, it was the Treasury's debt. In other words, what was happening was a fiscal deficit. They looked for some trick to get money issued. That money came into the streets, and then they wanted to sterilize it elsewhere by paying taxes. But the problem with the quasi-fiscal deficit was actually the failure to be honest about what was happening with the Treasury accounts. And as we demonstrated our commitment to fiscal balance, aside from the fact that the devaluation meant that what we needed was to arbitrage the dollar rate, that implied a negative real interest rate in pesos. This also allowed us to liquidate interest-bearing liabilities and transfer another portion to the Treasury. And what no one was talking about and what everyone said was impossible to resolve, between this giant Santiago Basile and Pablo Corneau, they fixed it in 7 months. I'm not going to be proud of my team. Naturally, then came the discussion about the put option. You're familiar with that discussion. At that point, we had moved on to discussing it. It's a speech I was making at the Buenos Aires Stock Exchange, and I talked about zero excess supply. Basically, what I was saying there was, we're only going to issue money through the external sector. Because if you notice when we were talking about endogenous money, in the case of an external standard, you only increase the quantity of money against the demand for money. That would be the argument. So, let's say that money doesn't generate a loss of purchasing power, or in other words, it doesn't generate inflation. Now, we realized we were wrong, that's the truth. Why? Because it's a free system, but this isn't in the textbooks either. So let's just say. Therefore, that self-flagellating question I have. My friend Alejandro Roseschner asked me, but it's in the textbooks? No, so what are you complaining about? Well, but one has this thing about perfectionism. And what we realized is that exporters selling dollars wasn't exactly about wanting to demand pesos. Because, let's say, in the traditional model, you have an operation in pesos that you want to carry out. You take your dollars. With those dollars you buy pesos, and it's with those pesos that you make the transaction. So, that demand for money is mapped against transactional demand, and that doesn't cause problems in terms of the purchasing power of money. Now, the problem is that when I have capital control and I'm forcing them to liquidate dollars, I'm buying pesos, but I don't want all those pesos, and the consequence is that now there are excess pesos, and that generates inflation. So, from that moment on, we decided, faced with a very complex situation and in which, let's say, there was a whole idea that the exchange rate would already be at $2,000 that Monday. I remember that Toto and I were traveling to what was my presentation at Sun Valley. And there, with Toto and Santiago via video call, we decided to change the monetary policy framework and go directly to zero emissions. We knew we ran the risk of being attacked anyway, but we had the firm conviction that if we didn't modify the quantity of money, sooner or later we would beat the market. Today, the exchange rate is at $1,150, and it's full of economist babblers. So, the point is, what have we achieved? Well, what we've achieved is that wholesale inflation is 2.1%, that is, we went from 17,000 to 28%. If you prefer, retail inflation, we went from 1,500 to 30%. But the most interesting thing is that, by policy design, there is a portion of inflation that is induced inflation, which has to do with the agreed devaluation rate and international inflation. I'm going to round it up to 2.5%, but it's already a little less today. So, if my latest CPI figure is 3.5%, it means that the true inflation of the program, the true monetary inflation that the program is generating, is 1 point. In other words, if I were to remove the crawling, that 2.5 automatically disappears, and therefore, I'm left with only 1 point of inflation. This means that the program's inflation rate is currently hovering at 13% annually. Therefore, if you look at it in terms of the CPI or WPI, and if you correct for the exchange rate pattern, you're going to find that we're talking about inflation levels that range between 13% and 25%. And why is this important? Because we achieved this miracle in terms of lowering inflation without hyperinflation. In general, let's say, it's more. The two previous successful programs actually had a strong inflationary process beforehand, which involved a sharp liquefaction of real balances, and consequently, there wasn't much more for the demand for money to fall, and therefore, it was much easier to stabilize. We did it without expropriation, which is why I often find it funny when people would say to us, "No, well, what day are you going to do this thing? I mean, you don't understand. I'm not a communist, I'm not a dirigiste. I don't believe in setting prices, setting salaries, setting interest rates, or sectoral policies. No, I'm a liberal, and the only thing I can do as a liberal is that my economic program includes a fiscal policy, a zero deficit, a monetary policy, zero emissions, and an exchange rate that's still not free until it finishes correcting the stock imbalances." And this is also important. Furthermore, we don't control prices, we don't control the exchange rate, and we also restructured relative prices. Today, regulated prices already cover 80% of the cost, something that seems like a minor issue, but it isn't. So, with all that, we managed to lower inflation, and it's in a range, if you will, of 13% to 25%. So, how does this continue? I mean, when do I get out of the trap? Well, look, time is God's. I don't know when the time is. But all these operations we were conducting were market-based, and being market-based means they will depend on the decision of the agents. Now, the most interesting thing is that when observed inflation tends toward induced inflation, what happens? Inflation disappears. And if inflation disappears, it means that money overhang disappears. As money overhang disappears, inflation will resemble induced inflation. Exchange rates converge, the inflation rate converges, and as I resolve the stock problem, when it reaches zero, money overhang is eliminated. And when money overhang is eliminated, there is no excess supply of pesos. And if there is no excess supply of pesos, I can open the exchange rate controls even if I don't have dollars, because I'm moving to a flexible exchange rate system. Obviously, what will it depend on? I mean, on how agents manage this dynamic until program inflation disappears. That is, only the induced one remains. We're lifting the controls. Obviously, while that happens, we'll finish resolving the stock issues, because that dynamic doesn't occur independently of what's happening with the rest of the stocks. And on that day, we open the controls. When? I don't know, but it will happen when all these conditions are met. That said, the point is how this continues going forward, because the question is, okay, we've established the broad monetary base and the observed monetary base. Let's say the traditional one, the traditional format is growing. But what does that grow in accordance with? For example, how does the dismantling of LaFees and others happen? Suppose you have a company and you see that demand is recovering. When you see that demand is recovering, what are you going to do? Are you going to lose market position or are you going to exit the money market? You're going to exit the money market. When you exit the money market, the bank has to give you the money. When it has to give you the money, it turns around and asks the state to pay the levy. So, there you have an endogenous expansion of the quantity of money. Why? To finance the movement of activity. In parallel, what's going to happen is that when money overhang disappears, what is it going to end up disappearing as well? The difference between the observed, traditional, and broad monetary base. From that moment on, the quantity of money is fixed. So, the question is, okay, once we get to that, let's say, I've eliminated money overhang, the base definitions map, my exchange rates have converged, my interest rates have converged. So, now I've opened, what next? Well, assuming the economy will grow, and I have serious arguments to believe it will grow, I mean, either because of the structural reforms that imply a jump in the economic freedom indexes of 90 places. And today we have institutions that are beginning to resemble, despite the degenerate fiscal systems, they are beginning to resemble those of Germany, France, and Italy. Still, that doesn't satisfy me. I warn you, I want Argentina to be the freest country in the world. Therefore, this implies that GDP, in fact, I saw part of Juan Pablo Nicolini's presentation specifically addressing the issue of growth. If I'm not mistaken, GDP doubles in 10 years, which implies a per capita GDP growth rate of 7%. That, let's say, on the one hand. On the other hand, folks, we just saved and returned 15 points of GDP to the people. We temporarily took a little bit from them with the pays tax, but we also already returned it. And, what's more, we removed it now in December, we removed it permanently. The first time we said we would temporarily raise a tax, we complied and removed it, and now, at the end of the year, we're also eliminating it. Furthermore, the continued decline in country risk will imply lower discount rates. Look at how much Argentine financial assets have risen. Well, if you think in terms of Tobin's Q, the market value is much higher than the replacement value. A fury of investment is coming here. And not to mention the RIGI, which has announced more than $50 billion in investments. But not only that, there are also issues that boost short-term demand. Because today, the installed capacity figure has already risen to 61.3%. In other words, there's a recovery in demand. And that's because real wages and pensions in real terms have been rising for 5 consecutive months. Furthermore, we had to reverse the inventory cycle, so we have temporary elements, whether it's the restructuring of wages and pensions in real terms, or the reversal of the inventory cycle, plus structural factors related to the RIGI, which have to do with the increase in savings within the economy, the decline in country risk, and structural reforms. So, let's say, when we realize we can maintain this course 10, 20, or 30 years from now, we'll be talking about the Argentine miracle. Thank you very much.